Hey, Fool, I was talking to you about SandRidge released their earnings after the market closed yesterday. I really want to get into the quarter. They really concentrate on the Mississippian Lime play that they've been focusing on over the last quarter or two. How did it produce?
Yeah, if you looked at their earnings release, they did very well. Their adjusted earnings per share came in at 8 cents. Analysts were expecting a 4-cent loss, so that was obviously very nice. And when you look at this company, they've been really trying to focus on two areas, and that's one, reducing costs and really trying to high grade their capital expenditures. They're also looking to lower the costs and really maximize the returns that they're getting. So, that was the big focus that they had, and they really went out and tried to tackle de-risked areas that were already held by production, where they already understood the economics there and could go in, drill, and get some type of certainty in what they're actually producing to really drive the ROI on their investments. And that's what they pretty much stuck to this quarter, and that's why they beat their earnings.
And now that they've isolated this as a core play, what have you seen as far as the production that really drove that net income gain rather than a loss?
Yeah, definitely. Really, the Mississippian is their core play now. And you saw really nice production gains here. 20% sequentially from last quarter gain, which is very nice. 88% year over year. Obviously, the year over year is a bigger number because they sold their Permian Basin assets, so they were putting more money in here. They saw the Gulf of Mexico also have some nice production. There, they had 28,000, a little over 28,000 barrels of oil equivalent per day, about 53% oil. This is a nice area. If you look at Hercules Offshore, who commands a lot of the rigs on the shallow offshore Gulf of Mexico, they really like the economics there. And I think that when SandRidge went out and bought the Dynamic Offshore acquisition, they were saying that it was a cheaper source of oil, and it has turned out to be there. You're looking at a little bit of a production cut because they're moving some of the capital expenditures away from that area, but still nice gains there. And then you're also looking at higher prices that they're getting from their oil and natural gas. Natural gas, especially since it was so low last year and they didn't have a whole lot of hedges in place, they had a nice gain from the natural gas prices.
Yeah, production obviously very important for SandRidge. But another thing you mentioned at the top of the video was cost. So how exactly did they attack costs in this quarter?
Yeah, definitely. Like we mentioned, they went out and were attacking areas that they already had a lot of understanding of. They've already done the tests, so they knew how much oil and gas they were expected there. And these are also areas that are tied into the infrastructure. Over the last few years, they really built out a wastewater disposal facility throughout the Mississippian and also electrical infrastructure. So they went out and really lowered their lease operating costs. They were down 20% over even last quarter, which is very big. And then you also look at their G&A costs. Similar to what Chesapeake did, they wanted to really go in and lower costs. This quarter was a little bit skewed because they had the severance package that they had to pay to Tom Ward. But if you back all that out, they were still $5 million less than the year before. So they are making gains, not as much as you saw with Chesapeake, but at least that's there. And then what was really important here, the big number to take away from this earnings, was they were looking to get under $3 million per well average cost in the Mississippian. They were hoping to do that by the end of 2013. They actually had average cost in the second quarter of $2.95 million, so they already beat that. Very good news on the cost side.
Yeah, it'll certainly be nice once they finally get out from the full umbrella of that severance package, as I know it's a pretty heady payday for Tom Ward. But now looking forward, you need a forward guidance as far as evaluation is concerned. So what exactly do you think this company has in store?
Yeah, definitely. They increased their guidance for the rest of the year, and they're basically stopping the CapEx. They're not going to go out and spend anymore like you've seen them do in the past. So they're going to restrain there, and you're also looking at a 15% total production increase, and then liquids increasing by 26%, which is very nice. With their balance sheet, they're still looking at $1.8 billion in liquidity. $1 billion of that is in cash. So, they had a very nice leverage ratio of 2.35 times. And, at the end of after the conference call today, the stock started tanking after originally releasing. And a lot of that is the company is not exactly sure how much money they're going to have to fund the 2015 drilling gap. And a lot of that is they're really looking to hit a lot of nice plays in the Mississippian Lime. So they're looking to spend that money in the next 2 years to attack those plays. So if natural gas prices stay at the level they're at now and don't really increase, they could have a funding gap at that time. If you look at their debt maturities, that's not really the issue because those are pushed back to 2020. It's really their capital expenditure gap at that time. So, there wasn't a whole lot of color around what they were going to do about that, and that's why the stock tanked after the markets opened and they had their conference call.
It was definitely a surprising move, caught me off guard. Hopefully they can learn from some of their own mistakes, and as well as Chesapeake with the whole debt burden that they've had to kind of undercover themselves from. So we'll see if they can learn, and by 2015, hopefully that things are wrapped up. So we'll be sure to check in on this company as it progresses on Fool.com. Keep fooling on.